All right. Hello, everyone, and welcome to the Market Huddle Live. It's Friday, February 28th of 2025. I'm Patrick Serezna. Kevin will be hopping on in about an hour or so to talk some charts, but I have the privilege of being joined by Lyn Alden from lynalden.com to talk everything macro. And of course, Danny will be on with us here to moderate some of these questions. So, let's just get started. So, Lyn, welcome.
Thanks for having me. Happy to be back.
All right. Well, while we're waiting for some of these questions to roll in, I wanted to start the conversation about just how this year has started. 2025 has created a macro backdrop that's arguably dynamically different than the years prior. And it has a lot to do with the current Republican administration that has come into place, introducing all sorts of dodge cuts on spending and tariffs and all of these different elements. Now, one of your big theses when you've been on our show in the past has been your theory or speaking to the importance of fiscal dominance. And now, as this is changing, do you think that monetary policy has returned as a driver again of financial prices, or do you think fiscal dominance is just as important?
So the short answer is I think fiscal dominance is still just as important, but other things have elevated importance to be of a similar level. And so, if you go back a few years during, say, the 2020, 2021, 2022 even, that was a very headline-driven environment. And by the time we got to 2023 and 2024, things were more mechanical. A lot of the kind of
Right.
the fires were put out. It's less headline based. It's more like managing liquidity, watching liquidity, looking at the banking system, just kind of like you could kind of predict a series of things going forward. At any given time there might be a debt ceiling, and then you got to monitor TGA and liquidity impact because that has all sorts of asset price implications. The regional bank crisis was an interesting thing to work through, but that kind of was like a lot of that was kind of on autopilot in a way, kind of back to more traditional macro. And 2025 has put us back in a headline environment again. And so things like major tariff announcements, Doge related activities. There are a bunch of different things that can like happen and have happened. Where you could have a whole thesis and then 5 minutes later there's a headline and you have to kind of like rewrite part of your report or change an aspect of your portfolio or something. And so it's not that I think fiscal is less
Right.
important, but I think that things like tariffs and potential currency accords, um, political activities, geopolitical stuff, that's all of that is kind of elevated. So now there's a multiple things that are similar. And the last point I'll make there is that so far with Doge, and my general thesis, and we have to kind of watch this play out to see if it's correct or not, and I would reassess based on how things go, is I generally take the under on how much deficit reduction Doge is going to have in the raw dollar sense. And
Right.
so I think they're going to have and they already have, but I think they're going to continue to have like a lot of little optical wins. And a lot of some of those are very politically impactful, certainly. But in terms of like fiscal activity on inflation or on nominal GDP growth or on certain sectors, so far, I think that's they're avoiding a lot of the really big areas that are like the third rails to cut that are very politically challenging. And so my general view is that when we get to say mid 2026, which is originally when Doge said they wanted to kind of have a lot of their cuts in place, like that they kind of gave themselves sort of a pseudo end date because that's the 250th anniversary of the country. So it's kind of like a very
Yeah.
memeable date. Um, and I think when we look back from there, I don't think that cuts will be massive, but I think that we're at least in kind of a physical consolidation at the moment. But we'll see what the numbers come in over the coming quarters.
Now, okay, that's certainly the fiscal cuts with the Doge, but obviously the tariffs are a big factor as well. And so, how bad do you think the tariffs are for the economy? And I'd like to split it up two ways. One, the actual impact on the economy, but two, the psychological impact, because when businesses around the world don't have transparency as to what's going to be going on moving forward, does it cause them to hold back on spending? Is this create a psychological effect that in itself induces a slowdown? Like, what's the impact in tariffs in your mind?
Yeah, it's a good question, and certainly between tariffs and Doge, I certainly view tariffs as a much bigger variable for my analysis than Doge. So I'm not taking tariffs maybe as quite as
Right.
lightly as I'm taking Doge, because when you've major headline announcements like 25% tariffs across the board on a major trading partner, or hey, we're doubling tariffs on China from 10% to 20%, and then you might roll that back, might not, and then um, that certainly, as you said, creates a very uncertain environment. One is for business investors. If you're trying to make contracts, it's just very hard. It's harder to do. This is
Yeah.
already the case in developing countries when they have kind of recurring inflation, currency debasement problems. Like we were talking before the call, that I spent a good time of each year in Egypt, and so there, that double-digit inflation is normal there.
Yeah.
Um, and you can imagine that you have to shorten contracting time frames. There's just more balls in the air that you have to juggle in that kind of environment, and that's all a administrative cost, and it reduces certainty. And there's a similar effect with tariffs. It's not quite the same thing, but when especially if you're involved in kind of major um, capex planning, or you have a lot of cross-border trade, it does create a lot of uncertainty at the business level, and then of course at the investor level, because stocks are, at least fundamentally speaking, in the grand sense. I mean, any given week or month or even year, it's mostly liquidity and sentiment. But longer term, a lot of the stock valuation is forward long-term expectations of cash flows and overall, company success.
Yeah.
And there's a much wider range of variance. This again more headline based. So I generally started this year, not like a mega bear, but just like more kind of cautious around this,
Right.
because we entered this Trump administration with a higher equity valuation than his prior administration. So it's already like priced even more for perfection than it was in his prior term. So there's certainly a lot of risks on the market, and I take the tariff side pretty seriously.
All right. Well, before we get to the next question, I just want to say hello to all of our live listeners that have joined in. This is a live Q&A, and we're looking forward to interacting with all of you. So those of you that have logged in, feel free to ask Lyn or myself any questions that are on your mind. So please get typing away anything that's on your mind, and we'll get to it as we go. So um, one of the headlines, Lyn, that was just crossing the tape was that the Atlanta Fed just their GDP now forecast came in negative, so they're almost anticipating a recession as we move forward. Do you think that this is driven by the very things we just talked about in terms of the impact of tariffs, or is there another macro driver for them to feel concerned enough that there's going to be economic slowness?
Yeah, it's a good set of questions, and that's kind of a shock variable. So I generally want to see a number of variables. I mean, they have a pretty high update frequency, so I certainly want to see that. I do think that tariffs are the biggest factor there. I think Doge around the margins is maybe relevant, but again, between the two, I think tariffs is the biggest one. It's very hard to forecast imports or exports in this environment, and then it's very hard to forecast margins, and then, like we said, there's psychological impact. So a company might just say, you know what, we don't even know how much we're going to be affected this year. So we're going to maybe hire less, or, if we have a range of spending plans, maybe we're going to err on the lighter side of those spending plans until we have a little bit more confidence or clarity about what things are going to look like. So I wouldn't be surprised. And it's interesting because we were in a period where there was this kind of weird period for like 2022, 2023, and kind of early 2024, where outside of fiscal dominance, if you look at kind of more monetary situations, there were some signs of recession. Like, for example, the misery index, so inflation plus unemployment, reached recessionary levels
Right.
during that period. And then, like, if you look at bank credit availability, during that whole rate hiking cycle, and then kind of while it was like plateaued. Um, over 40% of banks were like senior loan officer surveys were reporting tightening credit, which is generally what you see in a recession and only in a recession. So a lot of these kind of like traditional metrics were more like recessionary, but we had these massive deficits in the background, and we had kind of pent up pre-deficits like from the years prior. And so that's why I was kind of in this weird camp of saying, look, a lot of this isn't great. PMI's rolled over. A lot of these other things don't look great, but the fiscal aspect is strong. And then we started to see like a potential bottom in PMIs, bottom in lending. So
Yeah.
like maybe not lending is great, but it's not like getting worse. Like the rate of change is much better. Um, and so if you asked me a few months ago, I'd say, hey, it looks like maybe fiscal is going to go sideways for a while, but maybe some of this other stuff will stop, falling. But certainly, I think this renewed tariff and uncertainty environment really calls into question the likelihood of that private sector aspect stepping up, which overall I think does increase the risk of recession. And I don't really think in terms of Boolean like recession or no recession. It's more just like, is it a positive environment or a negative environment? And I think we're back in the more cautious and negative environment.
Right. So here, the one question just came rolling in, and right in line with such an interesting topic, asking that if Scott Bessett makes a Bitcoin reserve, if so, does he sell gold to fund it? Like, what would be the price reactions to both asset classes if something like that was to actually happen?
Yeah, it's a great question. It really depends on magnitude. My base case is they don't touch gold, uh, because why? Like if you have a money printer, why would you touch your gold that you haven't touched in decades? Now there are some reasons to touch it in the sense that if they there's like wonky mechanisms where like you can reprice gold and like fill the Treasury General account up with cash, and it's like an offset of asset and liability on the Fed side. So it's kind of this like accounting thing that happens, because they still book the gold that they have at like 50-year ago prices, and they can change that. They can technically sell some. So, but even without selling it, just by repricing it, they actually have some interesting buying potential. So we'll see what mechanisms they do. As far as the impact on gold, if you look at like World Gold Council, they estimate over 200,000 tons of above ground refined gold in the world. That's you're looking at 30, 40,000 tons at central bank level, and then of course tons of private investment demand, and then tons of jewelry demand. You generally have something like 3,000 tons hitting the market per year in new production.
Yeah.
Um, and so the 8,000 or so tons that the U.S. has, if they sell, 2,000 tons or 3,000 tons, which again wouldn't be my base case, but that's certainly market affecting. I mean, you could sell a year's worth of production, but compared to the overall size of the market, I think it's more of like a headline risk than, like a disastrous price risk for the asset itself. It's a big and liquid enough asset.
Right.
That's kind of one of the purposes. Now for Bitcoin, because Bitcoin's roughly the tenth of the size of the estimated gold market. And the if you take out lost coins, and I mean now with the correction, Bitcoin's a little bit lower. So it's a smaller enough asset that United States could have a massive impact on Bitcoin if they say, hey, we want to go out and buy 1 million coins. Now that's not my base case, even though there are some bills like the Cynthia Lummis bill and others that are advocating for pretty large purchases. My general base case is to err more conservative and assume maybe they'll ring fence the Bitcoin they already have and stop selling it and reclassify it. Maybe they'll buy a little bit around the margins. Certainly, as a bull on the asset, I'd rather be surprised to the upside than surprised to the downside. So I kind of assume little to nothing,
Right.
and don't really base my Bitcoin price thesis over any kind of multi-quarter or multi-year period on one headline of what the U.S. is going to do, because I'd rather have that headline be positive than negative.
Right. Well, while we're on this Bitcoin, I wanted to kind of just have a moment to expand on this, because one of the things in my mind that I debate and try to sort out is that as we've seen the securitization of Bitcoin, where whether ETFs, futures, options, accessible through very common channels of markets, it finds its way into portfolios that often hold equities and other types of asset classes. And before, Bitcoin seemed to have always had this personality to march to the beat of its own drum. But now that we've seen this trend happen and to such volumes, do you believe that Bitcoin is now going to be far more susceptible to the risk on, risk off cycles in broader liquidity events in the stock market? Like now, do you consider that, like, if we are going to have risks to equity markets here, that in itself poses some sort of short-term risks, maybe not the long-term bullish view, but short-term liquidity risks associated with market volatility?
Potentially, yeah, and there's some number crunching on this. So like NIDIG has done really good research on this. Like pre 2020, the correlation between Bitcoin and equities was lower. Then it became higher. Now, I generally a lot of that happened because liquidity became a much bigger factor. So when we're doing like major fiscals and monetary liquidity bazookas, the
Right.
correlation of a lot of things goes up. And so that's kind of been like an artifact of that. But then certainly, yes, of course, once we get the spot Bitcoin ETFs that we had, and then now we get these, these other aspects going on, more integration between Bitcoin and the financial system. That can certainly increase correlation. We also, I partnered with Sam Callahan, and we re-released a research report on the correlation between Bitcoin and liquidity. And we also compared other asset classes to liquidity. And at least the way we measured liquidity, Bitcoin had the highest correlation with liquidity compared to stocks, compared to gold, compared to bonds. Um, and I think there's a couple of reasons for that. One is it's so risk on assets generally have higher positive correlation with liquidity. So that's stocks, for example, whereas
Yeah.
gold's more mixed because it's sometimes it's risk on, sometimes it's risk off, but it's it's got a little bit of a different dynamic there. It's not a pure risk on asset. Bitcoin's interesting because like gold, it doesn't have earnings, but like equities, it's still treated like a risk on asset. And so in some ways, it's a more pure liquidity barometer or
Sure.
liquidity correlate than any other asset class of similar size. Um, and so that's my general view is that it's probably going to continue to be pretty heavily correlated with liquidity, with the exception of major headline risks. So the United States buys 500,000 coins. I mean, that's going to override liquidity for a period of time, kind of like how the election was really positive for price for a number of months, even though liquidity was not really great. Because when you have a major like administration change and major favorable shift toward Bitcoin, that can override that liquidity correlation for a period of time. So in general, I expect it to continue to be pretty correlated with liquidity as a base case. So if someone has a view on liquidity over, say, a 6 or 12 month period, Bitcoin is potentially one of the ways to express it. And now
Right.
there's other kind of industry specific variables that you can go to. Like a lot of my research kind of focuses on that because I'm kind of tied into that space. Um, and so yeah, I think there's be more and more kind of integration in that sense. In addition, it's one of the it's like the most liquid asset on like a weekend or one of it trades 24/7. So a lot of times people use it as like a weekend sell signal if they want to de-risk their portfolios due to something over the weekend.
Right. Right. So Rob online here has a question. What are the odds that Bitcoin has topped this for this cycle?
So it's a good question. I think cycles are probably going to look a little different. I think people assume that like the 4-year cycle is like built into law. I think as Bitcoin integrates more with the system and becomes larger, I think those cycles could change in structure. Um, and it's certainly the case that it could peak for a year or so, but that might be different than peaking for like a 2 to 3 year period. Um, and this goes back to the other metrics I look at. Like for example, there are on-chain indicators and other metrics of
Yeah.
euphoria that you can kind of measure in the Bitcoin space. And one of my favorites is market cap compared to realized cap. And realized cap is basically just on-chain average cost basis. So like, what is the price of the network except instead of using the current Bitcoin price for every coin, you look at every coin and price it the last time it moved. which is generally a lot of that volume is when people send it to exchanges or brought it from exchanges, which is a pretty psychologically important price level. And the point of all that rambling is that
Yeah.
when you have a big disconnect where market capitalization shot up way faster than cost basis, you're more at risk. It's a sign of euphoria, and the prices that we're seeing might not be, say, quote unquote, real because they haven't really been like liquid and realized for a long enough period of time. And what I would
Yeah.
say is that this cycle hasn't reached anywhere near the levels of euphoria based on that metric or similar metrics than the prior major like multi-year cycle tops. But for example, in like say March 2024, it reached like a moderate level, and we did get like a 7 month consolidation, and then it reached kind of similar levels back in say November 2024 when it broke out and kind of touched 100K for the first time. So certainly these like mid-level euphoria periods could give us
Yeah.
6, 12 months of consolidation. I would just classify that a little bit different than what we've seen in like major tops.
Yeah, well, for certain, just from a technical perspective, uh, like I'm going to pull out a crayon here, but it did double top and it's already 30% off their highs. So by all traditional metrics, we are already in some form of a corrective cycle. It doesn't have to be, a huge bear market. It doesn't have to be ominous, but we're definitely technically turned into some sort of a corrective phase. So it's just a matter of seeing how deep and how far this goes in this current distribution cycle. All right,
Absolutely.
Danny.
Yes,
Danny,
sir.
hop on here. What's is there any other questions that are coming in online?
Yeah, so we've got one from Eric for both of you. He says, why are mortgage bonds still so cheap relative to treasuries? They've been called mispriced for years now. I'm starting to wonder if there's agency or other risk there. That's for both of you.
No. Well, Lyn, you want to give it a shot?
So my best estimate would be, I mean, when you look at like last year, the Fed released a report, um, like their annual report, and they were kind of forecasting what they might do with their balance sheet, and they kind of eventually saw that they're probably going to bottom in their treasury holdings and eventually start going up, whereas they plan to continue to divest from their mortgage-backed securities over time through maturation. Um, and so that's like a market pressure that, I mean, if markets are very forward looking, that's certainly one really big entity that they're kind of paying attention to and say, well, maybe it makes sense to have a bigger spread between MBS and treasuries if the
Yeah.
Fed's going to start treating MBS and treasuries significantly different. And of course, there are many other factors involved, but um, it's I don't really view like catastrophic mortgage risk in that market. I don't really view as like super risky. Um, but I do think it's an interesting spread, and that's probably my best guess, or at least as a contributing variable for why that might be.
Well, absolutely. They are cheap relative to treasuries, and it's been a thesis that a lot of people have been trying to play out to that at some point they were going to catch up in some degree or another. They have been laggards, but I really wish I knew. I don't have anything smart to say about it in terms of why that's happening. Let's move on. Danny, do you want to read the next one, or you want me to?
Yeah, no, this one is for Lyn. So with rising deficits, how does fiscal dominance still hold? Gold surge and Trump's deficit concerns suggest markets are already reacting to fiscal risks. Does this contradict your thesis?
I would say that the market is there's a higher level of uncertainty around the thesis than there was, say, maybe 12 months ago. But the reason I don't think it contradicts it is because we can't just take claims at face value, right? So in the prior Trump administration, they said they were going to pay off the national debt, cut healthcare costs, XYZ, and some of their campaign promises happened, like tax cuts, but other ones are kind of very challenging to do.
Right.
And so these big claims like, hey, we're going to cut half a trillion from the deficit on a year after year basis. We're going to cut $1 trillion from the deficit. Those are rather large claims. And what makes it challenging is when you look at, say, for example, the 2024 official GOP platform, Promise 14, right at kind of the top of the document was, we're not going to cut Social Security or Medicare or raise the retirement age. Um, and so that's like a difference between this current era of Republican politics than say the Paul Ryan era. So let's call it the 2020, the kind of the 2020 era versus 2010s era.
Right.
Um, is that it's less about cutting these really big cost centers for the government. And one of the ways to get around that is to say, hey, we're going to cut a lot of waste, right? It's, government's full of waste. We're going to cut a lot of waste, and therefore we're going to trim a ton from the deficit without impacting things that really impact American citizens, right? That's kind of the claim you make. It's kind of like saying, hey, we're going to cut taxes, but we're not going to grow the deficits or have an inflation problem from doing this, or we're going to raise taxes, but we're not going to cause a recession by doing it, right? It's kind of like every kind of political party wants to have their cake and eat it too in terms of their signaling on what they're going to do. They want to advertise the benefits and downplay the potential costs. And so, in order to make really meaningful headway in the deficits, and I certainly admit that this has been certainly more shock and awe than we've seen in any kind of prior
Right.
attempts. So it's
Agreed.
certainly uncertainty is certainly elevated. I grant that. But when we see like, hey, we closed this $3 million real estate thing. Hey, we got another thing. Hey, we got another $1 billion thing this time. When we're talking about like $2 trillion deficits with like, and we did actually another report on this. I did one with Sam Callahan on the whole fiscal dominance issue, and basically like over 80% of the spending growth expectations over the next 10 years are tied to those more entrenched entitlement programs. And so they take rather significant overhauls to go after. Major overhauls of Medicare, major overhauls of Social Security. The big area, DoD, that's probably one of the biggest variables because the whole thing, Pentagon's not audited, really big cost center, very politically entrenched. I mean, every single congressperson tries to defend whatever like
Yeah.
DoD spending's happening in their district. So that's like a whole political thing. And again, we have to watch that play out. So I think, once we get, we're, you know, 5, 6 weeks into administration, I think we have to watch this play out a little bit longer. But I still like whatever kind of the market based case is, I generally take a little bit of the under in terms of at the end of the day, raw numbers. So
Right.
not the number of optical wins, but the raw numbers. Like, are we going to have the deficit? My base case is no, but I do think that we are at least fiscally consolidating, which means I don't think the deficit's really going to grow this year. And so I'm certainly for multiple reasons, from deficits to tariffs, more generally on the defensive.
Right, and that makes a lot of sense on that front. Now before Danny, before we ask one more question, just again a shout out to everyone. Great questions that are rolling in. Would love to hear some more from everyone. So any other questions on people's minds, keep firing those questions into the chats, and let's get going. So Danny, what's next, buddy?
So we've got one from Rob H. If geopolitical tensions persist but nothing major happens, what's Lyn's upside target on oil and natural gas for the next few years?
So no major things. I think a lot of this probably trends sideways to maybe mildly up. I think we probably get a little more consumption out of Asia. And the biggest factor right now is tariffs. I mean, but when we look out further, I don't see major supply limitations. I may be a little bit less bullish on energy than I was a few years ago, just because supply the supply side picture is looking a little bit better. And my general favorite way to play this has been the producers and the pipelines. So I've had the thesis that we're not in like the 2014 to 2020 environment where
Yeah.
massive supply glut, like terrible for oil and gas companies, over leveraged pipelines blowing up. I think 2020 was the like mega bottom for a lot of kind of the
Yeah.
industry. So I do think we're in an environment where owning the equities, at least the high quality ones, that can enjoy chopping along in terms of like prices is pretty good, because a lot of them are trading at pretty attractive valuations, um, pretty strong balance sheets for the bigger ones. The cheaper they get, the more cash flow they can put in like buying back their own shares. Their dividend yields are pretty high, so it's basically you're owning this thing that's like paying a pretty high shareholder yield.
Yeah.
There are really attractive pipelines that are paying like 6-7% and growing that distribution year after year, and they don't have the same kind of like leverage Ponzi dynamics that they had in kind of the pre-2014 environment that a lot of them had. Some of the smarter ones changed their capital practices ahead of time, like say Enterprise Products Partners. Other ones kind of had to find out the hard way and like blew up, and then kind of changed their capital methods. But I generally, the reason I like the equities here is because I'm less convicted around the oil and gas price per se, other than I generally discount the downward tail to say that I think the market's a lot more balanced than it was in that kind of environment where, say, shale was ramping up quickly and disrupting the entire kind of oil supply demand dynamic, and that now it's more balanced and therefore pretty good for industry players. And I also generally take somewhat of the under on how much American production is going to grow. Not to say that it can't reach new highs, but that it's not as simple as a political question, because a lot of the reason companies were kind of not drilling a ton is because they have uncertainty around prices, and
Right.
inflation has impacted a lot of their supply costs. So they need fairly substantial prices to be pretty aggressive on capex. I mean, back in that kind of 2010s environment, everything was like drill baby drill. It was like, when you make money, put it back into the ground, and they would raise a lot of money from external investors and put it into the ground. A lot of them were drilling without being free cash flow positive. Whereas now, a lot of them are saying, hey, we want to have a good balance sheet, we want to pay a good dividend, we want to buy back shares, and so that all of that competes with, do we want to put this back into the ground and get a lot more production online? And there's faster decline rates across shale. That's not news, but that's a thing I monitor pretty closely, because that's an engineering reality. Um, and so I think altogether the market's more balanced, and when things fluctuate by $10 to $30, I don't. It's hard. I'd rather look at a technical
Yeah.
analysis for that. But as a producer and pipeline investor, I'm pretty satisfied with how the forecast looks long term.
It is interesting though that natural gas has substantially diverged from oil in the recent months. There's been a material rise in natural gas prices, and it's not just the seasonality of the rolling up the term structure. It's been a meaningful spike. And uh, do you think that the regional element of natural gas has got its own story that's going to play out differently? And would you consider any equities in the natural gas space independently of that oil and gas theme, or oil theme anyway?
So I was previously looking at that thesis. I've since, because I focus on so many areas, I've kind of
Yeah.
just decided not to have a strong opinion on that, and defer to the experts. The kind of the background thesis there is that so oil is more fungible on average, which is to say, other than kind of very difficult pockets of production with very low infrastructure, generally speaking, there's less of a gap in oil prices across the world, because the transportation costs are manageable. Whereas natural gas, because transporting a gas is harder, pipelines and LNG are just a bigger cost center relative to the
Yeah.
production. And so you have much bigger regional differences in natural gas. And so to the extent that more and more export capacity keeps getting built,
Right.
and then assuming no major tariffs or political things that kind of stop this, you should over time see that spread narrow. So say European and Japanese natural gas prices compared to North American gas prices should maybe at least get a little closer than they historically have been, which would in theory be bullish for North American natural gas prices.
Right, right. And so let's move on. Again, just a shout out. Great questions coming in from the audience. Keep them rolling in. We've got Lyn here for another 25 minutes. So let's all those of you that had something on your mind, make sure you fire it off to us. So here's a question from JG is the initials there. There's a reason, he says, there's a reason to suggest that the Fed is ending QT. How long before they begin QE? And what signals should we look for, such as a spike in repo rates? Uh, is there something that you want to talk to the quantitative easing and tightening cycle?
Yeah, it's a great question, and I did a lot of this research back in 2019 when we were getting close to that repo spike, and then of course when the repo spike happened, and then all the macro debates were happening on why the repo spike was happening. And in that case, you basically went straight from QT to QE. That's not necessarily it's going to be the case this time, but that's what happened last time. So that's kind of our most recent baseline, which is like 5, 6 years ago. Is you kind of over tightened and then hit a liquidity floor and had to bounce up pretty quickly. And that was all pre-COVID. Months later, COVID happened, and everything kind of went vertical. And so the things I look for, one is any usage of the repo facility. And so especially we get really good signals at the end of each quarter, because that's when all the banks and other entities are doing like window dressing with their liquidity. And so there are certain institutions that need liquidity, and as we get on average, as like the Fed keeps tightening and there's kind of less base liquidity in the system, couple things happen. One is that the price of liquidity goes up, and so the various spreads break out. And then two, in some situations, you could have someone tap the Fed's repo facility. We saw that like 2 quarters ago. We didn't see that at year end, but we saw that in like the end of Q3, if I remember correctly. And it was a very small tap. It was something like 2 billion, but it was a minor signal.
Right.
And then in quarter 4, that didn't happen, but the price of liquidity right at the end of the year was sky high. So that all of that is an ongoing sign that we're maybe getting closer to a liquidity floor. And then when I look at reverse repo, we're currently at 180 billion. So we're still this kind of past 2 years. Of reverse repo reductions, which was largely partially due to like excess T-bill issuance. But a lot of that reverse repo money, like 2 trillion worth, went out of the market and back into the market at the same time as roughly the same amount of QT kind of pulled that liquidity out. So you had kind of a flat liquidity environment. And once reverse repo is effectively drained, so once you're kind of persistently sub 100 billion, there's not a really big offset for QT. And so my general base case is that we probably will see the end of balance sheet reduction this year. I don't have a strong view on what happens with like how quickly they get to QE, because partially that'll come down to our prior question on how much deficit reductions happened. What are like other factors that are happening in the market? So basically each quarter we get a pretty good
Yeah.
signal, and I tend to be in the camp that by the end of this year we probably see kind of the bottom of the balance sheet.
All right, Danny, how are the questions coming in? Is there anything new that you want to ask Lyn?
Yeah, so I'm sorry if I pronounce your name wrong, but Poojan says, can Lyn share her thoughts about how many hardware wallets should one have for Bitcoins? Basically asking about UTXO management. And he also says he loves your work.
I appreciate that. That's a very specific Bitcoin question. It really comes down to the individual. So as a really kind of brief thing, one of the benefits of Bitcoin, like gold, is you can self-custody it. So instead of having like an entity hold it for you, you can self-custody it. And what kind of security or hardware device you should have, or how many, would really depend on how many Bitcoins you're storing. If someone's holding $1 million worth of Bitcoin or $10 million worth of Bitcoin, that's different than someone who has $2,000 of Bitcoin kind of tucked away in a sock drawer, right? So there's a difference of variable. There's like some cheaper methods, like say tap signers. These are like NFC cards. They cost maybe, I don't know, off the top of my head, $20, $30. And they're like really great for kind of lower amounts of Bitcoin. And then as you get kind of higher, some devices are $100 or $200, and those are kind of suitable for holding more substantial amounts
Yeah.
of Bitcoin. And then when people want to get really secure, there's multi-sig. So you can set it up so that it takes 2 out of 3 keys or 3 out of 5 keys in order to spend or move your coins. And so you can have say 3 hardware wallets and then a mobile device and then a company that holds the 5th key for you, or some kind of combination thereof, and you can split the locations of those up for those people that are holding millions of dollars worth of Bitcoin and don't want like a $5 wrench attack to kind of come after them. So say, hey, you want my Bitcoin? You got to drive me around all my bank safety deposit boxes and see how that
Yeah.
goes. So I would say, really depends on size of the holdings, and then also education level, right? I mean, but some of these are pretty simple. Other ones are pretty complex. It's not really rocket science, but there is a learning curve. You're kind of storing your own money, similar to if you were to hold gold in your house. You have to understand what you're doing. So that's kind of my range of answers. It really depends on how much. Yeah.
Fair enough. All right, Danny, any other ones?
Yeah, we've got a few. So let's have a look. So the bartender mechanic. It's an interesting name. Geopolitics between the left and right, question mark. Do you see governments getting more or less extreme moving forward? I guess that's quite a specific question as well.
Well, so during I've had the general view of this whole kind of quote unquote fourth turning environment that there has been this kind of structural shift toward higher levels of populism. And of course, they
Right.
ebb and flow, but you generally get higher highs and the higher lows of populism. We've seen this in North America, really ever since like the whole kind of post global financial crisis. So Tea Party, and then MAGA, and then on the left, you've had the kind of similar like the you know, BLM, and not to get into everything, but you had these kind of rising political tides. And of course, in Europe, there's been, especially ever since the sovereign debt crisis there, some of the more right or kind of nationalist, kind of less greater Europe and more kind of focused on a country. Those parties have been gaining traction. I generally expect that to continue to increase until there's some um, game change shift, like kind of major geopolitical alignments, major currency moves, major shifts that happen. So I generally am of the camp that political uncertainty is going to continue to be high. That doesn't mean that sometimes it doesn't go down for a period of time, but that's going to be an ongoing thing because the pendulum tends to swing kind of back and
Love that
forth.
analogy.
Yeah, and we've been, especially the past few years, you kind of hit one side, and there's been pushback on that. So I think that pushback, I think, is still underway, meaning that we're probably still moving toward more populism and on average a little bit more kind of like right. It depends on the place. I mean, right and left differ depending on what place you're like. European right and North American right look pretty different. And European left and North American left look pretty different. But I generally think that yeah, the pendulum's kind of still swinging away from where it kind of hit in say the 2010s.
What's interesting is I love that pendulum analogy, and I try to just say like all we're seeing is the same pendulum moving that's always been there. It just so happens that the pendulum happens to be swinging that much deeper left before it goes that much deeper right, and it's got more velocity both ways. But it always seems to work out that everything goes down the center as the pendulum is swinging both ways. So, but it is certainly polarized politics today. All right, Danny, what's up next?
So we've got one from MM, and we've had a question from this person before. But if inflation rises, doesn't that put policymakers in a catch-22? I agree, politicians want to continue spending, but rising inflation could limit their ability to do so, undermining fiscal. Oh, sorry, it's gone. Fiscal dominance. Sorry, there you go.
Yeah, so I think the short answer is that liquidity crises trump inflation. So when there's high inflation, central banks generally want to get tighter. But if you have a dislocation in the treasury market, if you hit the liquidity floor in like bank reserves and you start to get really messy quarter end stuff every time, central banks kind of have to step in, and that's kind of part of their kind of informal mandate. Um, we see there's kind of two ways you can look at this. So one is in developed countries. Back in the last time we kind of had this kind of fiscal dominant environment was all the way back in like the 1940s, and you had very high inflation associated with the war, and you had central banks saying, "Look, it's the war. We gotta pro liquidity into high inflation to support it." And then a less extreme example is just like in developing countries around the world, they'll have above target inflation, and the central bank is still basically monetizing government deficits. Now that's why those currencies are often less attractive, but you generally see less extreme versions of that in um, uh, developed countries at times when you have very large fiscal issues and other things. Like I don't think that like if you have a dislocation in the treasury market, fiscal deficits are high, you're not going to get emergency cuts to Social Security, Medicare, or defense to the tune of hundreds of billions of dollars before you're going to get the Fed say, hey, for technical
Yeah.
ample reserve reasons, we're going to go to a neutral balance sheet approach, or we're going to go to we're going to get back to normal of like, keeping balance sheet growth in line with GDP growth. I think they're not like high inflation means that they generally can't say, hey, we're going to stimulate by doing a lot of excess QE to promote growth. But it doesn't really prevent them, at least the way they kind of, I think, look at it or kind of have to look at it, is to say, well, we're going to keep the wheels on the cart uh, with like liquidity and market functioning, not stocks per se, but like repo, treasuries markets, those kind of core markets, they keep the wheels on those kind of regardless of what we see on the CPI print.
You know, I like the conversation we're having here. I just want to kind of dig a little deeper. So obviously the consensus is that we're in a new higher inflation regime, and whether that is, most people argue that that's hovering in that 3 to 4% range, north of that 2% target zone, not necessarily runaway inflation at a higher level. But if we were to see a negative feedback loop begin in the economy that spurs some sort of recessions and drives asset prices to correct down lower, could you see in this environment a period where we could still see sub 1% front rates in the US? Like, do you think that the Fed would cut that deep again in another cycle?
My guess would be no, um, unless inflation was sufficiently low to give them the signal to do that. I think they'd be a little bit more cautious. I mean, it would depend on the extremes, of course. If you have a major, like 2020 era thing, I mean, then maybe that's different. But in a normal kind of recession, I think that they'd be balancing that between the two. And
Right.
on average, I kind of had the view that maybe rates are less important than liquidity, as far as kind of asset pricing and things like that. So in this kind of era of fiscal dominance, 50 basis points or 100 basis points in either direction is less interesting to me than what the balance sheet of the Fed is doing, and what the size of the fiscal deficits are doing. So if they cut 500 billion off the deficit every single year, that's a massive impact versus the Fed changing interest rates by even 150 basis points or more. So I think, and most of the central bank's tools are based around promoting or suppressing bank lending. Because, for example, the 1970s inflation that was famously put out, by Paul Volcker and other things. One was geopolitically get oil prices under control and oil flowing around. That was kind of
Right.
the non-financial thing, and then the financial aspect was there's very big demographics. So the baby boomers were kind of entering their home buying years, and you had higher than average bank lending. So higher than average money creation from bank lending. And high interest rates often suppress that. It's an effective tool. It's a tool for doing that. The problem in the current environment is that if bank lending is not very high, it's not no one. It's not like bank lending's booming. That's not really the source of inflation, and yet most of the Fed's tools are around either promoting more bank lending if, say, they view things as sluggish, or trying to suppress bank lending if they view things as hot. But if bank lending is only like the second variable versus fiscal deficits, it kind of means the whole central bank is sort of playing second fiddle, in that fiscal dominance environment, unless, again, we go back to the my non-base case, but that some questions could come up, unless they do manage to say meaningfully cut the fiscal deficit on a sustained basis.
All right. Another question that just rolled in here from Kegler. I hope I pronounced that right. It would be amazing if you could talk to the other precious metals, silver, platinum, palladium, and if inflation is coming up with the new QE cycle, are commodity equities the place to be? Or is it too early to know?
Well, when I look at, say, my newsletter portfolio, the sad little area is like a little slice of platinum that's been sitting there for a couple of years, and a little slice of silver that's been sitting there for a couple of years. So like my equities are great, gold's great, and Bitcoin's great, and
Yeah,
and the the
they're
little,
just
like,
sitting there.
the other ones that are sitting there. And it's,
Yeah.
my general thesis has been partially, I do. So a lot of people like to compare Bitcoin to gold, right? It's like, hey, Bitcoin's going to eat into the gold market. We had the prior question, hey, is America going to sell gold and buy Bitcoin? I think the more interesting question is does Bitcoin eat into the silver market and the platinum market? Um, and that's because if someone is a hard money enthusiast, a precious metals enthusiast, they go to gold if they generally want stability. And also, there's very large buyers of gold, central banks that are often not buying the others. So it's a certain market. People that like that hard money or precious metal, they want like monetary metals, even though those are both industrial and monetary metals, but at least the monetary component, they generally want higher volatility. So they're bullish on precious metals, and they'd rather have, say, the miners or silver or platinum. And the challenge there is that when you have Bitcoin and crypto, it plays to kind of the same crowd with that similar
Yeah.
level of volatility. So Bitcoin is, I think, when you're looking at a portfolio and you say, well, between Bitcoin and silver, which one do I want to own? Or Bitcoin and platinum, which one do I own? Or Bitcoin and gold miners? It's not really per se. Bitcoin is gold, at least in my view. So I do think that's been a non-trivial. When you're looking at like a $2 trillion market cap Bitcoin versus these are, Bitcoin like briefly surpassed the estimated market cap of like silver.
Yeah.
So these are like comparable market sizes, and they do at least on the monetary portfolio side they somewhat compete. And I think that's a somewhat permanent state of being now. Like that's like a new thing that just is like a new part of the market, kind of like how shale is a new part of global equity market. So um, I think that's an ongoing disruption. But I do think if we get a major inflationary cycle, I'd be bullish on silver and platinum. So I'm kind of a long suffering, bull with tiny positions in them. So I'm kind of right there with you, hoping that they do a little better.
They are definitely cyclical in nature. So at some point, there's going to be something that's going to drive them to have some sort of an upturn in the market.
Yeah.
So it's just a matter of allowing those big picture cycles to fully play out.
Yeah,
Danny,
it
yeah,
might be that their industrial side takes over, like supply
yeah,
demand of the industrial side. Like it gets bad enough that maybe that drives it, and then of course speculation and investors jump on after that fact. That's certainly a
yeah,
possibility.
absolutely. Danny, how's it out there in the question world? We got 5 more minutes.
There's quite a few. We've also, sorry, I might be having some connect. Starlink seems to be,
Yeah.
Elon Musk seems to be proving that he's not working very well today. So if there's any connection issues, I do apologize. This one from J and J Limited. Does Lyn have any opinions on non-energy commodities and related equities, bullish or bearish?
Not really at the current time. I used to be I mean, during like say 2020, I was bullish in a copper, but then all the copper equities jumped, and then I kind of got out of the market, and it's been tricky to get back in. And so other than the big energy ones, I've been more, like I hold some diversified equity. I mean, commodity exposure, like companies either involved in multiple spaces or ETFs. There's some like broad commodity producer ETFs that give exposure to things that are maybe below my radar as like a high level macro person. Like I can't have a well-informed opinion on every given commodity. So a lot of the smaller ones I'm just not closely tracking.
Right.
There's quite a few, but we've got another guest here that can join us. I don't know if you
Oh,
want to. Should we let Kevin join?
yeah, well, let's let Kevin.
Okay, hold on. Here's Kevin now.
Hey guys.
Oh,
Hey Lyn,
hey.
thank you very much for being on the show. It's great to see you.
Happy to. It's been a while. Nice to see you.
Yes, it has been a while. Patrick, do you want me to chat with Lyn for the last 5 minutes?
Well, we have a couple more questions, so let
Okay,
Danny ask at least one more, and then you can and fire a question or two off for her.
Okay.
We can keep her a few more minutes.
Okay, so this one's from Jack Yolden. Hopefully, I said that right. What does Lyn think of MMT economics? Economics. I'm sorry, I got that wrong.
MMT.
MMT, yeah. Get wrong or miss. I'm reading Broken Money at the moment, which is fantastic.
Oh, nice. I think that it's fairly descriptive. I think individual MMT economists have different views on what to do with that, description, how to prescribe. I think a lot of what we see in MMT is kind of based on like having the global reserve currency, basically the idea that you kind of exclude a lot of the external demand or lack thereof. So like MMT in Egypt, where I got back from not that long ago, is different than MMT in the United States. And the public perception of MMT is generally different than what MMT economists often talk about. Even though I often find myself disagreeing with, say, MMT prescriptive things to do, it's often different than, say, what the public perception will be of MMT. Like they don't just say run large deficits and go from there. So I generally think that the issue there is that they kind of maybe downplay the costs of monetary debasement more than they probably should. And I think that's maybe one of the bigger flaws of that whole thesis.
Great.
Danny, are you going to keep going, or should I chat with Lyn for the last few minutes? Because I think we lost Patrick.
No, Patrick's got. Patrick's nipped out for 2 seconds,
Okay.
so it's just you and Lyn. So I don't know if you've got any questions for Lyn, but there
Well,
are.
sure. You know what? I'll finish off with some stuff that's non-market related. Lyn did mention she's coming back from Egypt. I would love to know how are things there, and how was your vacation? I know last time I spoke with you when we interviewed, you were headed off to spend some time with family. Just would love to kind of hear what's going on in your kind of personal side and talk a little bit about Egypt.
Yeah, so the thing is that the market itself, like, and that's kind of the difference between a developing country and a developed one, is that when we think of like, say, 5% inflation in the US, it's like everything's on fire. That's kind of how people perceive it. Whereas like in Egypt, it's like Egypt inflation might be 25% or peaked at, officially like almost 40%. And it's not that different than when we went there like the prior year when it's like 10%. And it's like, of course it is, especially in certain parts of the market. Like it's not to say that people aren't struggling, but it's like the whole kind of it's geared around a little bit more chaos and fluctuation. So generally speaking, like my experience this trip was say not that different than my experience last year or the year prior. Certainly more political tensions given the regional issues going on. One of the challenges with Egypt right now is that it's just kind of been in a stagnation. So when you look at say energy consumption per capita, which is a really good kind of measure of developing country growth, it's not looking good for like the past decade. Like you had this kind of multi-year period of pretty high energy growth per capita, and really under this whole kind of past decade, it's been trending kind of sideways to even down on a per capita basis. So population growth kind of hides how much per capita the economy struggling. And then high inflation impacts people like, a car price in local currency terms might have tripled in many
Right.
cases. And yet, um, most salary, if you ask most people, hey, did you get triple your local currency salary compared to 3, 4 years ago? And they'll say, of course not. I got, maybe double, right? So the number of hours worked to buy a car is like many cases higher for people. So generally especially on the bottom half of the income spectrum's kind of suffering. Um, but it's kind of been that way for a little while. And I guess the other interesting thing I like to point out there is that I often like to point out how much like Chinese cars are taking over. And
Oh,
if you say that to an American, they're like, what do you mean? Like if you ask an American to name like one Chinese car model other than like, the BY, like the electric ones,
right.
they can't really do it. But like in Egypt, there's like ICE Chinese cars like everywhere.
Yeah.
Yeah, like everywhere. Like they're the
I
biggest, like,
actually drove one when I was last year in Grand Cayman. I drove a nice Chinese car. It was
yeah.
shockingly great. Like it was a Chenang or something like that. It was a terrific car.
Yeah, and they're kind of and I've seen this kind of over the
Yeah.
past several years. They hit that inflection point where they went from understood to be cheap to like it's kind of like following the trajectory of like Hyundai. Like first it's like, oh, that's the cheap car, and then it's like, oh, actually Hyundais are pretty solid now. It's kind of
Yeah.
like they're China's going through that same exact cycle where and they kind of hit that point where especially in Egypt when you're having say, car prices tripled, and Chinese enter the market and say, well, ours are actually a lot more affordable for kind of a similar amount of car.
Right.
So
And
it's yeah,
you mentioned Hyundai, and that's obviously the Koreans. But my father tells the story of like when Japanese came to North America, it was the same deal. It
yeah,
was people were like, oh, these are crappy
Right.
cars. Like the first Honda, I think, was a chain linked motorcycle engine, and it was crappy. And not only that, they'd never had salt on the road, so they were just abysmal for many years. And now they end up being the greatest cars out there in terms of reliability.
yeah. I think we're seeing the same approach. Like I have less personal experience, but I understand at least historically that's what happened, and I'm at least old enough to see the Hyundai evolution a little bit. So it is interesting, and now kind of seeing in firsthand over say a 4 or 5 year period, China going through the same cycle with their cars. And again, we don't unlike Honda and Toyota and Hyundai, we don't see it in the U.S.
Right.
But you do see it in the BRICS and the developing countries around the world.
All right.
Well, Lyn, thank you so much for joining us. You gave us a full hour. It was great to have you on, and looking forward to having you back and join us again for another one of these. So thank you very much, Lyn.
It's great to be back and happy to see you both again.
All
Thanks,
right.
Lyn. Take care.
All right. Take
Bye.
care. Cheers. All right.
All right. Okay. Well, that was very nice of Lyn to do that. That's very kind of her.
Yeah, well, you know what? Instead of doing a normal episode, we decided to do this live. So we can't finish off a show without shooting the shit about some charts.
That's right.
Uh,
So it's time for talking charts.
yeah, so let's fire this up. And so Kev, let's just start off. Like, it was interesting because me and you chatted a little bit about uh, what was happening right as Nvidia reported its earnings, right? And so it was Wednesday, and it looked like Nvidia was it was a nothing burger reaction, at least in the after hours. But once the markets opened up here, I'll just quickly pull up Nvidia's chart up here. It started the morning gapping up to about $35, and they just hit the bid, and a $15 drop from that point. Some they leaned right into it and just kept hitting the sell button. What's your first impressions on the selling?
Well, one of the things that I did think was interesting is that if you look at the kind of where it's pinged around, they were
Yeah.
expecting a 9.5% implied move. And one of the things that I've highlighted is that often you can use that as a point to fade. And I think that I don't know exactly on the upside whether it was at exactly 9.5, but it was around that level. It was up 8-9% when it kind of stalled out. And that's something we've often seen in terms of when you get a beat on one of these big Mag 7s and you get that rally. By the time it opens and then it sells off, and we finished down 9.5%, which was exactly what the implied move was. In terms of bigger picture, Patrick, you know me, I've been a huge bear. I continue to be a bear. I am increasingly believing that Fleckenstein said once, I think he said that AI is going to be one of the biggest effing airballs in tech history. I happen to agree with him. I think that at the very least, in terms of what's priced in and the expectations, it's going to be shockingly difficult for them to reach kind of the expectations, and that the food fight of CapEx spending that has occurred is going to prove to be a lot of money wasted. And we're seeing it now with, Microsoft trying to back out of it. And we're hitting this point where it just ends up being this kind of all at once. Everyone's realized that they've probably taken this too far.
Right. And what's interesting was there were very few Mag 7s that were unscathed from that. Literally, when that turned down on Thursday, Apple turned down below its 50-day moving average. Amazon got hammered down over $10 on the downside. We're now 5-6 days below the 50-day moving average. Something that only usually commonly happens once a clear new downtrend may be underway. And Google just getting hammered almost 3+ weeks below its 50-day moving average, completely wiping out the November to January rally in one fluid motion. Microsoft about to break down to like 1-year lows. 1-year lows. Like and it's been a very range bound stock, but we're basically you have to go back to January of last year to where we were at these levels. So if it breaks any further, we're talking about 52-week lows on Microsoft. Meta is at least holding at its 50-day moving average, hasn't yet beaten Fibonacci zones, arguably holding up the best out of them. But then Tesla just as well getting hammered below its 50-day moving average. It's already $100 below where across the 50-day moving average. The selling has been relentless in this name. So this entire Mag 7 basket has just the rotation is underway. And there's the asset managers and hedge funds that needed to be overweight this for them to be able to have participation and outperformance. They're now rebalancing their weightings. I'm not saying they have to dump everything, but they're certainly reducing their holdings and sprinkling that money elsewhere, particularly into places like the consumer staple names and others that have been holding up.
Okay, before you do that, I know this is talking charts. I know this is your part, but I was pretty bearish there on Mag 7, and I just want to introduce a little bit of fundamentals, or at least
do it.
Do it. So for those who are interested in terms of seeing the kind of other side of the AI bull argument, meaning the bear argument, I recommend you Google the generative AI con by Edward Zitron, Zitron. It's a February 17th piece, and he goes through, I believe he's more of a technologist than a market guy, but he goes through what how he sees this technology and where he thinks the market, or at the least the expectations of this technology, are way, way ahead of themselves. So the generative AI con, Edward Zitron, February 17th, 2025. Google it, spend the time to read it. I highly recommend everyone go and check out that article.
All right. Well, so let's keep on this, and what's clear is that there was a big breakdown in the market. The S&P 500 is back to its December or early January low, but there's a couple indices like the NASDAQ that clearly now have broken 3-month lows, and so there's been a transition in trend on this front. And Kev, though, I love with my members to use a football analogy. I always like to visualize trend by imagining an American football game. It's the Bulls versus the Bears, and I ask the members, like, who's in possession of the ball? Like, who's the one that's making the drive, who's making the yards? You might lose yards along the way, but you're the one that's making the drive. You're the one that's playing offense, and the other side's playing defense. And the Bulls have basically been in control of this market for 6 months, basically since those August lows. And we're looking for, where was there going to be a turnover? Where was it going to be where the ball was transitioned over to the Bears? This type of a breakdown, there was a fumble, a turnover. The Bears are going to try a run with this. So now it's a matter of seeing where they take it. But the 6-month run on the upside seems to definitively have played out, and some sort of a down cycle has started here. The question is, does this turn into a correction? Like, for instance, when we had the yen carry trade unwind, we had let's just going back here on and this is the NASDAQ chart. Back then was about a 17% correction on the NASDAQ that took about 26 days. As scary as that was, it was fast, violent, hit a bottom, and then the bull market resumed in very short order. So the interesting question here, are we going to see just a typical 5 to 10%, even maybe a 10+% market correction that lasts the remainder of the month, or a chunk of the first quarter, the remainder of the first quarter, let's say? And does it just reset everything for another bull run? Or could this be where something more ominous is underway, where this is transitioning into potentially a prolonged distribution cycle, something to the 2022 nature, where we went through, a year of markets just struggling? What are your thoughts on that?
Unfortunately, it's a little bit of a politics game right now, and I hate to. I'm the last one to start saying that you need to follow politics and that geopolitics affects markets, because a lot of times I think that they're overblown in terms of their importance. But I do think that when the politics have such severe economic kind of policies attached to them, meaning the tariffs, that it very much will matter a lot. So if this continues, Patrick, in terms of Trump wanting to go ahead with tariffs, I am extremely bearish. And I think that he is going to do it, and I am bearish over the long run. I was just clipping for one of my articles I'm writing recently. Steve Cohen is sitting there, and I can't tell you how much I loved his interview, because he wasn't letting his politics get in the way of his positioning. And he's just saying, look at this. The fiscal deficit is coming down. And whether that's good or bad for the economy over the long run doesn't matter. Over the short run, it means lower economy, lower stock prices. He's talking about immigration slowing down. That's negative for the economy. And he's talking about the fact that Doge is, cutting all these things and creating uncertainty. He was quite bearish. He was the most bearish that he's been in a long time, he said. And I just loved it, because he's not letting the kind of the politics of what people think drives stocks, in terms of people are looking at this. And remember, it was only a month ago or 2 months ago, Patrick, that everyone's falling all over themselves bullish because of Doge. And now people are realizing that, you know what, if you go and you cut the deficit, it probably means lower stock prices. And you can argue about that, but you just have to look at the empirical evidence. And we could sit around debating whether over the long run it's better for the economy. I don't really care. I'm interested in where it's going over the short run, or the short to medium run. And to me, it's been very clear that part of the reason the U.S. stock market and the U.S. economy has done so well is because of the fiscal side of things. And if we have a situation right now where the fiscal is going to be cut way back, and we have all this uncertainty, it seems to me pretty, obvious that the stock market's headed lower. So put me in the Steve Cohen camp.
All right. So Kagler asked, if I pronounced that right, sorry if I didn't. He asked if they sell the Mag 7s, does it create the liquidity for the broader side of the market, where asset managers obviously do sector rotation? My first answer to you is that yes, but that's not going to be necessarily reflected in the indices themselves, because they're market cap weighted. So for instance, we were talking about, let's say, the rips in, let's say, Coca-Cola going to the upside, or the let's say the reversal in Mondelez. You could go, or Kraft, or any of these. Like, you can go through all these consumer staple names that have literally been rallying the entire time the Mag 7s have been selling. There's clearly parts of the market that are going to be net benefactors of money managers having to reallocate that money elsewhere. And so there would definitely be that redistribution. But the thing is with the market cap weighting of these S&P 500 is so huge that it's going to be very hard for the rest of the components to drive that market higher, and especially when sentiment is being so badly damaged, when they see the kind of selling that's happening in the generals in the market. Do you have something to add to that?
Nope. You got to bang on. And I completely agree. The only thing I would say as well, though, is maybe some of the Mag 7 selling goes into other countries.
Yes. Yeah,
right?
we could talk about that. Certainly, yeah, because it's you're seeing Europe ripping and other places like this. That has to be a part of that rotation for sure. Right. So here I have just a quick chart of the breadth of the S&P 500. And what's interesting is that, to see that the Mag 7 selling is, let's say, being sprinkled abroad, causing the other parts of the S&P 500 to rise as it's being a redistribution or sector rotation. That's not evident in a chart like this, where we struggled with the market at all-time highs, with the breadth of the market to even exceed 60% of stocks trending above their 50-day moving averages. And here we are at 47%. And when you take something like the S&P 500 equal weight index, it nowhere near approached its previous highs, like the S&P double topped. It's rolling over at fib zones. And while I believe the equal weight index will, on a relative basis, do better and be a safer place to be than the main S&P index, I still don't necessarily think it will diverge and trend the other way. Anything to add to that?
No, I don't have anything to add. Sorry, you know what, you're catching me. Like, the markets are, I don't know if you've been following, Patrick, but the market's been all over the map. It's been an exciting time when you and Lyn were chatting about the markets. There was a little bit of a dust up in the Oval Office about Trump and Zelensky.
Oh, a dust up.
Dust up, to say the least. So it's been a little spicy.
Are you gonna share the dust up?
Well, no, everyone. I'm sure people will know. Anyways, you just Google it. Go Google it. There was a tense exchange of words, and it's definitely creating a lot of spiciness out there in the markets.
I love it. Some spiciness. Anyway, Danny, if there's any other questions that are rolling in or stocks that anyone wants to look at, make sure you just either jump in here and give us something or type them into the chat for me.
Of course.
All
right. In the meantime, Patrick, keep going. Let's get your talking charts.
Absolutely. No. So anyway, the markets definitely are feeling a little bit heavy here on this front. So the interesting part from a traditional intermarket basis, and some people could argue that traditional intermarket relationships that existed in decades past have evolved or are not going to be as sensitive as before. But one of the things that typically happens, at least in the past, during a risk-off cycle in the markets, is usually you see a strong dollar. And it's interesting, Kev, is because I can't think of someone more bearish the dollar than you. And the laugh that you have is perfect. It's just a smirk like you wouldn't believe. But you have to give it me something here, Kev. Is your entire thesis of based on the short-term top being in any way confirmed by this absolutely pathetic price action, that this is what you want to lean on, that this is the big turn point in the dollar?
No, I'm not. I was,
Okay.
I was actually, right. I'm getting DM'd from my pals. So
oh yeah.
That's what it was. But I will say one thing. Look, Patrick, I do want to highlight one thing for the dollar bulls out there. So there's some dude, Paul Bluestein. Bluestein. I'm not sure how I say his name. He's probably been on that show You Cheat With Me on. He sounds like your kind of guy in terms of like he's a macro voices kind of guy. He says he's written a book and it's just published recently. And I thought this was great timing. King Dollar, the past and future of the world's dominant currency. He's publishing it today.
Bam.
There we go.
That's it. That's a nail in the coffin right there.
There you go. So I forget about the charts. I got my book publishing. That's,
right.
It's right up there with the coming war with Japan. And that's one that I love just bringing up. And that guy, he's never going to be on our show, so I don't have to worry about making fun of him. But it was something published by George Friedman, and it was published in 1991. And for those who are interested, go Google it. The Coming War with Japan, published by George Friedman and Meredith Labard, 1991. How they thought that this the economic rivalry between these two countries had to play out in terms of a physical war.
There you go.
There we go. So that was a great book. Actually, I should buy that book.
You know what? I
should find that book, and I should have that in my library.
You should. I think that's.
And then not only that, you know what? When I get my library, you see behind me, my books are like.
I bet you can even find it.
Sorry, go ahead.
I'm pretty sure you can even find it for free at one of those
maybe, but it's, you know what? Maybe everyone's bought it. But when I get it, I'm going to definitely put the picture up there the other way. Like I'm going to put it instead of having my books arranged like normal humans, where
you're going to make sure that.
Because there's a famous, Canadian economist that takes every book out of his bookshelf and he puts it that way so you can know what he's reading. So I have to do that as well. You know who you are.
Okay, so
you're gonna find that like all your Macro Voices guests won't be on our show. I'll piss them all off.
It's entirely possible. So, the going to the dollar chart here, irrespective of that big picture macro thesis that you have based on such sound logic, this is an actual interesting moment to find out whether the dollar has another rip. So I'm going to use a nice thick crayon to connect just like this a declining wedge formation, which is a typical corrective pattern that happens in the middle of a bull phase. And so after a bull run on the upside of the dollar, all we've really seen is the dollar go through a pause, mean reversion, and correction. The only and this is true for almost every cross currency pair except for your favorite one, the yen, which in fairness, the yen does look like it has more relative strength to the other cross currencies. With that said, let me just make the point.
Okay.
We are crossing a 50-day moving average and attempting to break out of this descending trend line. And all I am technically observing, technically only, that if we're in a risk-off cycle and these levels break out, it would be particularly interesting to see whether or not the next leg of a dollar advance gets underway here, in spite of all of the bearishness of the Kevin Muir crowd.
Okay. So it's not just the Kevin Muir crowd. The currency whisperer has reached out, and it's not just about yen anymore. Let me see if I can pull this up. Where is it? I'm trying to get it. You know what? I wasn't quite ready. My Outlook.
Okay, no.
Once you keep talking about this thing, pull up the yen. I'm sorry, pull up the euro, because that's what he was sending me notes about, and I thought that was really interesting.
Oh my God, this chart is brutal. Tell me that the yen whisperer is not doing charting.
Oh, the yen whisperer is he's not the yen whisperer. He's the currency whisperer. So first of all, don't just degrade him and put him as a yen trader only. Okay. And
my bad.
He is the ultimate crayon chewer. And I don't think he'd be wrong with the thinking about that. But he said, okay, listen, this is what he told me. And this was Tuesday. He says, Kevin, if you don't already own some euros, in my opinion, time to get on board. Oh, there you go. He's the currency whisperer is buying the euro. I asked him why, and then he said lots of reasons based on charts, crayons to you. But he said, that being said, I had to go back in time. But 1 second, he's just put through all these different kind of reasons, but he says at the end of the day, he's just like, it's kind of more feel, I think is how yeah. He says, thankfully, I don't really care about all that, but if color's what you need, there you go. So listen up, folks. Don't mess with the currency whisperer. He gave me the heads up. Solicited. I didn't phone him up or send him an email saying, what do you think about the euro? Out of the blue, he says he likes the euro.
All right. Well, I have to say I'm on the other side of the trade.
Good.
So
that's what makes the market.
So yeah, exactly. I was about to say he can separate me from my money. Let's see how he does. It's interesting. Anyway, obviously we're both traders and we both have the right to pull the plug on it. But right now I'm comfortable with my position,
which is short euro. You hate the euro.
I think, long the dollar.
King dollar.
Long the dollar against most currency pairs.
You got to say king dollar when you say it.
No, because
you do, Patrick. Come on. If you want to be cool on your other show, you got to do it.
King dollar.
Okay, there we go.
But in fairness, I do think that you will be right within a year. And there will be a US dollar bear market. So I'm not king dollar like milkshake theory shit. I'm talking technicals. I'm talking technicals now. I believe that there's still room for a 3 to 6 month advance in the dollar, and that whole narrative to be really either a back half of the year story, if not a 2026 story. That's my thesis. We'll leave it at that. Okay. So let's touch on. We were talking with Lyn about the big drop in Bitcoin. And it certainly did a big acceleration to the downside. But it is particularly interesting that the sell-off has more or less approached the Fibonacci zone, so about a 50% retracement of its prior rise. And this is a particularly interesting moment for me technically on charts like this, because often major trends will mean revert 50% of their gains. This is actually a very kind of common. You could go back to Charles Dow theory back 100 years ago to on that basis. And so it would be particularly interesting to see whether Bitcoin can find a tradable short-term low down here at these levels, because if it doesn't, then it's a lot more ominous. And so particularly if I was to give you a little bit of an analog of what would look bearish, is that even if we did get a reaction here, if the price action just sits here in the 80,000s for even 2 or 3 weeks, that's not good. Like at that moment, this thing could go Eiffel Tower straight back down to even much lower levels. As far as I'm concerned, the bulls need to get this within weeks back up into the 90+ thousand area with a little velocity, solidify that was just a little liquidity sellout, and that in fact a new bull continuation patterns underway. I'm gonna take it. I don't have positions in Bitcoin. This is just me making a purely technical call with no skin in the game. It'll be interesting to see whether or not they can muster up a bounce at these levels.
Well, and Patrick, I just want to do a little bit of a shout out to you, because I think it was a couple of weeks ago you highlighted that level. You said that the Bitcoin was trading below the moving average. It was bouncing along support, and if that broke, it would get ugly. And sure enough, that's what happened. So good for you. It was a good call, even though it was very much like
sometimes a broken clock is right twice a day.
Although it was very much a technical call. If it's going to go, if it breaks this, it'll go lower and keep
well,
going.
I was observing the fact that all rallies were failing, which is a distributive price action. So it was observing. It wasn't just a crayon line. It was about the fact that there was simply no buyers in sight showing any accumulation, and that the sellers were more dominant, and that's evident in the price action.
All right. What else you got?
Gold's correcting.
Yes, it is.
And so here we are, and no major, at least as not I'm aware of, no major announcements from like the administration or something that be a catalyst. It was a correction that was, I've argued overdue. We collared up our gold positions up along the highs, and we were looking for retracement. But as far as I'm concerned, there's a bull trend that's intact, and as it approaches this $2,800 area, there's an old technical rule that says what were all the previous highs act as support, and as we get down towards 2,800 or so on this correction, if the buy on dip traders come in the way that they have in the past, then that will be a really kind of line in the sand for me as to whether or not the bull trend is still intact and whether there's another full leg higher. But very similar to the 2 to 3 month correction that we had over here in this horizontal triangle, it's not at a line that this 4-day correction that's already started is going to be a 1 or even a 2 month consolidation, a period where gold just takes a break. And it doesn't have to be in any way bearish, just simply gold does this. And after such a bull run, gold pausing here is just a very typical ebb and flow movement. I think that 2,800 is a very important level to watch.
You said buy on dip traders, and you said that plural. We all know there's only one buy on dip trader that matters.
Oh my God.
People's Bank of China, baby. That's all that matters there. Are they going to stand in? Where do they buy it? Here's my prediction. They're not going to buy it at the most obvious technical point. They'll let everyone panic. So whatever number is, like, whatever the moving average or whatever the support is, they'll let that go through there and get everyone bearish, and then they'll just scoop it all up.
All right. You heard it from Kevin. You know what? Let's see what happens, buddy. Copper. What's interesting about copper is it's traded to the highs where it was back in September of last year, and overall the price action over the last since the start of the year has generally been accumulative and positive. Higher highs, higher lows, flagging formations, find support at moving averages, Fibonacci zones holding, all those things that generally are associated with something that's trending. The question is that if we do see this broader selling underway, can copper march to the beat of its own drum? Can it just at this point break out here, or as I'm going to watch a smirk on your face, or is Dr. Copper going to tell us something?
God, I hate that. The
All
only
right.
thing that's worse than Dr. Copper, the cleanest shirt in the dirty laundry pile for King Dollar
true.
or whatever. Put them all together and just like, it's like
Yeah.
that scene from Zoolander. I threw up in my mouth a little bit.
All right. Well, listen, a quick pause. Listen, all of you joining us live, don't leave Kevin, me hanging to just talk here by ourselves. Join the conversation, even if it's just to take a cheap shot, or if you want to throw us something that you want to look at, a stock.
Give Patrick a chart. Put him on the spot.
Put me on the spot.
Any stock name.
Just not penny stocks. Give me something with some size.
Something with some size. Okay, here we'll do one. Val.
Oh, okay. That's struggling there. Valeris is I don't know. Do you want me to say something bullish?
I want you to give us your technical opinion.
It's shit.
It's what?
Shit. It's shit.
It's shit.
No, but like it. Look, I know that there's a number of people that are doing some strong fundamentals on this and are you believe in the storyline, but somebody is hitting the bid. Like that, there's someone unloading this thing, and they're just hammering it.
I'm gonna go out on a limb. It's getting washed out. It's time to start looking at buying this thing. I know there's nothing, and the reason I brought it up is because technically there's no reason to buy it, and there's absolutely nothing there. Okay, let's do some more Tidewater. Let's go fast.
Yeah. Just saying, Tidewater here. It had its earnings, also broke to a lower low. You know what? While I agree with your washout theory, I'm certainly not opposed at all to the idea that there's going to be a buying opportunity soon. Right now, I think you have to still leave it alone for the next couple of weeks. I don't think it's now. I think we can circle back to this in a couple of weeks when we get back on the show and see whether or not they've technically
fair enough. Rio,
put in a bottom.
Keep going. Let's come on.
All right,
speed round.
What's interesting is that all of these iron ore plays tried to break out. Valet tried to break out. BHP tried to break out. A whole number of these. They got above their moving averages. The trend line started to break. But look how fast this faded off of that breakout. So it was looking actually very positive. But this type of distributed price action of the last 5 days it just means not necessarily that there's a big downside to the stock. These things have been in a bear market for years now on the downside. It's just likely to be stuck along the bottom. Almost think of the way crude oil is stuck in its mid 60s to $70 range. This could end up being a ping pong match for a double bottom retest and trading up in the 60s again for a little bit before this thing bases and starts a bull breakout, maybe and even in the second half of the year. It's going to be I think you have to be patient with a story like this. Which one you want to look at next?
Well, before you do that, I'm just going to back up a little bit, put a 5-year Rio chart on. To me, it looks like it's in a huge range, rangetraders.com. It actually, I think it looks fine in terms of one of these days it'll break out to the upside. Okay, Clove.
Stop right there.
Yeah.
It's making persistently lower highs as you're going down. That's a distributive stock. More importantly, the last year has been distributing along the bottom end of its ranges. So if we put like a high volume, like a volume nodes on here, it's trading at the lower end of that. if it's going to go to the bottom of its range, you're talking about still the risk that it's coming all the way down to this $50 area on the downside. All right, what do you want to look at next?
Clover Health, CLOV. And by the way, I'll buy the Rio from you.
All right. So
Clover Health, CLOV as in Victor.
All right.
So we might be breaking our penny stock rule here, but
no. Look, it gapped down on its earnings. I hate doing technicals on first reactions on earnings because you got to let the flows show over a couple of days. Obviously, this has been a really nice bull run up until then. With this type of a gap, it is reminiscent of what happened back over here on its last earnings cycle. And when it kind of makes the kind of a gap off the highs, it's probably going to be stuck in a consolidation of some sort for thing. It doesn't necessarily have to be bearish where this thing is going down to $2, but I'd curb your enthusiasm that things are going to make some big bull breakout here on the short term.
Pretty good. Pretty good. Okay, Lyft.
Okay. If I can type.
Keep it going.
So this is a stock that obviously had a vicious bear market, and it's been stuck in a basing accumulation cycle down here for a prolonged 2+ years. At some point, you could be looking for a bull breakout, but there's no evidence that it started. So I would consider this stock to have a lot of support, a lot of money coming in here to accumulating at these price levels, but we haven't yet seen the beginning of something that's a new accumulation cycle. So it's one of those things that could break out, but it hasn't started.
Okay, CNQ. This is the one that's near and dear to my heart.
Oh, well, do I break your heart?
Yeah, you're gonna. I can tell already that it's
shit.
The crayon guys won't like it.
Well, look, Kev, when was the last time this thing was able to stay above its 50-day moving average?
Yeah, no, I'm not going to disagree with you. Listen,
right? All rallies are failing. It's this distributive cycle. Measured move is probably even down to $26, $25. You're talking about a stock that now has the risk of finding lows probably down in its pocket. Now, on that end, do you sell it? Do you short it? Absolutely not. This thing is way too mature. This is a probably 7th, 8th, even 9th inning of a decline. It has probably a few more dollars risk on the downside, but you don't go shorting it. It's just there's no sign of the bottom yet. So it's one of those things where I would put this on a watch list. And over the coming weeks, I'd be looking to see where my spidey senses are saying that a bottom is in, and you could start trying to dabble. But it's a pretty bearish chart right now in terms of its trend, and there's no reason to believe that it's going to shift that trend.
Okay, we got two more. Basically, let's do India and Hang Seng.
Okay, so. Well, this is the India ETF. Well, actually, let me just pull up the actual Sensex. So this is the Sensex index. It looks like the CNQ chart. Like it attempted to break out. I remember having the debate with you as to whether that was a potential bull breakout on India back in November. And I was just entertaining the idea because it got above its 50-day moving average off of a Fibonacci zone and seeing whether they can start a run. But look at the way that breakout failed. And the moment the breakout technical signal failed, it's been relentless selling for 3 months. And at this moment, this is definitely in a distribution cycle. There is some key supports coming in on there. Along all of this levels right here that could potentially stall out the short-term selling momentum, but this is a primary distribution cycle, and there's no evidence that something bullish is immediately happening here.
Okay, Hang Seng.
All right, so you've got it's a chart that's been bullishly trending. It certainly has room to continue, but the question here is that can an index like this diverge and march to the beat of its own drum the way that Europe is. And maybe, like, I mean, generally, I have a broader thesis that that I'm starting to question, that risk assets generally correlate, but as money is rotating out of the U.S., like we've talked about, as the Mag 7s are selling, this money might be internationally redistributed. And that's when you look at the way the Euro stock has been running, it's a very similar style chart. And these indices are still holding up. So there's a real chance that some of these areas that have been working very well can continue working.
Okay, so Marcus has got a question. He says, what's your opinion on stock volatility? Everyone says it's going to explode, but at the moment, VIX is moving rather slowly. Perhaps the uncertainty is not strong enough. Do you want me to do this, or you want to go with that one?
You go first.
Okay, so I actually wrote about this yesterday in my kind of daily recap. One of the things that I watch for in terms of volatility tops are when the second and the seventh contract of the VIX curve invert. And we're still a long way from those inverting. It doesn't feel this sell-off has not felt that scary at all. Although the VIX is up, I think it's up very minorly in terms of the big picture. And I continue to like owning volatility and don't think that this was the top in volatility by any means.
There you go. Overall, volatility is rising, but I feel that it is event driven. So the more something scary happens, the more short-term options become the thing, and everyone goes grabbing at hedging out the most immediate downside risks in the market. At this moment, we are at if you put in there, the only time we've actually traded at levels of volatility, we are basically back at almost a 6-month high of vol. And so, I mean, we are gravitating higher. Risk premium is being charged into the markets. The question is there going to be some sort of a scary moment in the market that something breaks, some announcement happens, something that spooks everything and then drives the next sell cycle? It'll be interesting to see.
Okay, and then Byron's got a question. Thoughts on short-term inflation-protected bonds over the next 3 months? Tough question. I'm going to take this one because I do talk about inflation a lot. Short-term, I'm going to assume that you're going to mean that like a 2-year note that we're going to trade. In terms of, you look at what the 2-year note itself, it's yielding 4% today, and you compare that to the 2-year tip. The 2-year tip is 0.82. So that gives you a break even of 3.2, meaning that if you were thinking about the different alternatives of whether you should own 2-year nominal notes or 2-year tips notes, it will depend on whether you think over the next 2 years inflation is better than 3.2. I happen to be a long bull in terms of inflation. Having said that, we are reaching points where even I am like, you know what? I think the economy could be weaker than people expect. And I suspect that inflation won't be as high if we do getting a rolling over of the economy. So I understand why people would reach for this. And over the long run, if you're talking about owning 10-year break evens, I continue to love those. I think that that's going to do great. Having said that, for the next 2 years, if you're going to own this position for the next 3 months, I might actually take nominals, which, Patrick, like that's for me as a big bond bear, that's as kind of bullish bonds as I get.
Oh, let's pull up that chart because I'm pretty bullish, but
you're always bullish. That's
no,
like,
I was flat bonds for a good chunk of that decline, dude.
I didn't own them as they were going no bid in the free fall. Boy, you deserve a medal, buddy. I'd pin it
What?
to your chest, but you don't have one to pin it
Fine. I don't short bonds very often, so I don't join your club. But I
to.
generally look for bull trends to trade bonds higher.
Come on,
So
really?
yeah, I
Honestly,
don't.
you like the long side of the bond market every now and then?
I technically trade the long side of the bond market.
No,
I do. I
I
did
know.
it. I
I
did it.
understand.
I did it.
I think
So
the long end, by the way, is way ahead of itself as well. So I
oh,
think the front end of the curve has got too much inflation priced in. The long end has
you
got
know,
too much hopes
you know
priced
what
in.
is what's interesting is we talked about SOFR the last episode, and particularly the December contract. They were pricing essentially 4% interest rates for the rest of the year. Look at that. They just literally in the last 5 days put an extra 25 basis points into cuts.
Yeah,
Uh,
and I think I agreed with you that there's a good chance that the economy rolls over and they price in a lot more cuts.
yeah,
Where we disagree, Patrick, is the long end.
yeah.
Whether the playing it on the long end is going to work, and I think that you could have a situation like, let's face it,
See,
you were bullish bonds because the Fed was cutting and the economy was slowing, and yet the Fed cut 125 basis points, the 10-year went up 100 basis points. Now it's come back down since then, but the reality is it's a tough game, the long end of the bond market. Anyways, let's keep going. Let's keep going with questions here. Cameron mentions, he says, you mentioned that you'd consider taking a stab at Val.
yeah.
How do you stem the bleeding after losing fingers? Asking it as a fellow contrarian. So Cameron, you're assuming I have any fingers left. I am now fully on to toes and I'm down to just a couple. The reality is that you have a couple of different ways. You just trade it small enough that it doesn't matter and you can sit through the pain, or you pick your point. You say to yourself, okay, even though there's no real technical reason it's going to stop here, it just feels washed out and I'm going to buy 35 60s and I'm going to risk down to 30. And there's you pick your spot and you just do it. The only thing I would say when you're doing that, pick a spot that's not likely to be hit. Because if you go and just pick, some stop that's within the traditional kind of volatility range, then you're just going to get stopped out.
Yeah.
So my advice would be trade it smaller.
I have some advice.
Okay, go ahead.
Well, I tend to try when trying to catch falling knives. I try to put on the chainmail glove, and therefore I usually use some form of an option strategy to actually first dabble in something that gives me the ability to get out at a definable loss. I'll be the first to admit that I on the earnings of Val, I put a position in and I collared it in with a 42.5 by 50 collar. So it's a relatively vol neutral that you're selling vol and buying vol at the same time. And when the 42.5 gave out on the downside, the puts knocked me out of my position. And so I took a loss, but I took a shot on the potential turn and it wasn't there. You flatten the trade. I like to define that a little bit with options. To me, especially this way, you almost have to you have to accept that you might be wrong even 3-4 times in trying to figure out where the bottom is. As long as you're taking paper cuts each time you're trying to catch it, then eventually when you catch the turn point, then you have a long-term buy and hold position. So that's always the way I like to think about it.
Another way that I might do it is I might sell some put spreads, meaning I sell a 35 put and buy a 30 and just sit there, and that way if it continues, I'll lose the whatever it is, the extra bit in terms of what the put spread credit versus the difference between the two strikes. But it in essence is doing the same thing as you, Patrick. It's defining my risk and allowing me to be stopped out. The other thing that I like about selling those put spreads in this sort of environment is if we do get a situation where it continues to go down there, I end up being long the strike that is more out of the money, and often sometimes we'll actually get an increase in volatility, and you get a bump. So I actually love doing that trade in terms of selling put spreads into this sort of declining market. Okay, Danny's got or no, not Danny. We have another question. Do you see any U.S. following EPI/India? They had a similar bump after the Modi election and gave up everything. So I am a huge bear in terms of the U.S. stock market, and I think that it's going to continue to leak, and money will go into other things, and we'll see money flowing out of the U.S. into Europe, Brazil, anything else, and Japan even. And one of the things that I think that people keep forgetting is how overweight most investors are in the U.S. Yeah. And that's all you need to know is that even if just people want to go back to benchmark weighting, it's going to be a lot of selling, and that's ultimately one of my beliefs is that process has started. Tips ETF option. Okay, well that's actually I don't have any tips ETF options. Yeah, I don't know in terms of the trouble about those options is that they trade at very low premiums and they don't really move. It's tough to get really excited about the tips product in terms of the sexy trades out of that. All right.
Listen, I had it. Yeah, I'm
you're beat. You're beat. So thanks for tuning in. Now stick around for the after show.
It was great to have Lyn on. It's been a while.
Nice. Yes. Oh, I didn't realize this. He's playing some music over us.
Nice.
Is that what always happens? I didn't even realize it because I've never listened.
This is the after show music, guys. I'm pleased that you finally just heard it for the first time.
No, but it was great to have Lyn on.
She's you know what, we had her really early in her career when she was not as much of a big star, and now she is just like a FinTwit celebrity, all-star rock star. So it's nice of her to keep coming back on the show and chatting with us.
I agree. So how's the weather out there in Toronto, Kev?
Oh, it's shit. It's terrible. And not only that, Patrick, it snowed, and our city is becoming useless at taking off the snow. So I was actually out of town, and I got back, and I was like, "Oh my God, they still haven't cleaned up. They were still going down Yonge Street, clearing off the snow. It's just absolutely abysmal." And by the way, we had an election yesterday. I don't know if you know that, Patrick.
No,
you're not allowed to vote anymore.
Yeah.
Doug Ford, Rob Ford's brother, by the way.
Yeah.
He won re-election.
He's
Well, he's a funny. And here's a little side piece of trivia for those who don't know. So Rob Ford was that just joke of a mayor that got high on crack.
Cocaine.
Yeah, got crack. But the funny part about this story is I have a buddy who literally bought his drugs from Rob Ford when he was in high school. I thought he was kidding me. And I was like, no. And I was like, oh, what? You mean he just had some extra drugs and he bought them? He goes, no. Rob Ford was or maybe it was Doug. I think it was Doug. Doug's the smarter one. There's Doug Ford was a full-on drug dealer. And I was like, really? He's like, yeah. We all bought our drugs from Doug Ford. He knew where he was. And it's I was like, how old was he? He's 5 or 10 years older than these high school kids. And so basically we have a drug dealer as a premier.
Oh, there you go.
Well, you know what he is, it's good. He's good with business, I guess.
Yeah. But you guys, it's record snow out there, isn't it? So when I was there, so I was there just for that family day long weekend, and it got 60 centimeters in that weekend. They shut down the airport. Pearson was shut down, so I missed.
That's because a plane crashed, buddy.
No, the Sunday. No, dude,
a plane flipped over and crashed.
Stop. You're ruining my story.
Okay, I'm sorry.
You're ruining my story.
Sorry.
So Sunday, I'm supposed to fly out and make it out to Lisbon for Monday morning so I can start a normal week. And Danny, what's that? There we go. Got the music going right. But so the flights all get canceled. All the flights from the snow, they literally canceled flights from too much snowfall. Then my flight got moved to Monday, and so I was supposed to fly out Monday, and then the plane flips and shuts down the airport a second day in a row. And my flight gets canceled a second day. And so basically, I didn't fly out until Tuesday because of all the drama. But you know, like
everyone was feeling sorry for the people who almost died and were covered in jet fuel. Don't feel sorry for them. Feel sorry for Patrick. He missed his flight.
It was awful.
God damn it. Why can't they just take off around it? Like, seriously, there's other like runways. Drag it off. Just take like the tractor, just pull it off the runway so Patrick can get out.
He is an international man of mystery. He needs to at least be flying.
First of all, what the hell is Patrick doing flying commercial anyways? We all know you fly on the PJ, right?
Yeah. That's it. I've got. Oh my God.
Meanwhile, I'm at the back of the plane with all my kids and sit beside the toilet.
You poor
thing. In there.
You poor
Patrick's
thing.
flying in the PJ back and forth.
We have no beer to rate. I didn't even bother to crack one open.
What did you guys feel like doing the live stream? This is the first ever live episode that we've done from start to finish.
I don't know. I'm still upset about the video. So you're forcing me to do all this stuff I don't want to do. So the reality is I'm bitter at the video and now it's live and it's getting more and more complicated. There's music playing in my ears.
And he's happy. He doesn't have to do any editing.
I know that is brilliant.
Now you know. Now you understand why
it's been revealed. It's been revealed. He gets the Friday night off. He just has to
Let's do these live all the time. Listen, I don't believe in editing anyway, so I'm always for just leave it all in there.
Yeah.
Right. And for those who don't know, go listen to the Tony Greer, Kevin Muir early show, number 7 or something. The worst show we probably ever did, although it was entertaining because Tony drank something like 11 beers. One of our listeners said, I counted the beers and I'm pretty sure it was 11 or something. It was like a lot
because you could hear each one crack.
Yeah.
I try to be respectable and drink one beer during the show.
Yeah. Well,
I get
Tony.
I can slur a lot when I have too many.
Well, I mean, yeah, I've been a part of that on many occasions, Pat. So,
but Tony, though, you don't even know he's drinking. He's just a machine.
Oh,
he's a great guy that way. Actually, I did a live show the other day with somebody. I was cheating on you, Patrick.
Okay.
And Tony tuned in and asked a question. I was like, Tony, what are you doing? I was like, let's go for some beers.
Maybe we should get him on then. Maybe we should get Tony Greer.
Oh, there you go. You should do a live with Tony.
Yeah.
Oh, yeah.
Yeah.
But we're going to get hammered.
Yes. You should do a live. You know what you should do? You should do a live and then number of beers while he's doing it. See if he can beat his old record.
I could do a tally chart, a live tally chart, and see how many beers that he does. Maybe
I think he's getting older. That was a long time ago.
Yeah.
He probably slowed down.
Yeah.
Oh, well.
Anyway. All right.
I don't have anything to say in the market's open. So why don't we call it a day?
Yeah,
thanks for everyone for tuning in, and we'll see you in a couple of weeks. And thanks for everyone. Take care.
Thanks, everyone. Have a great